Welcome to part 8 of the 10-part executive training series for the PivotBoss Premium Trading Room. This is part 8, ADR Method Targets, Average Daily Range Method Targets. I am Frank Ochoa, aka PivotBoss, and again, this is another fantastic topic here that can help you in your trading, regardless of the time frame you trade, regardless of the instruments you trade. These are fantastic price-based targets that allow you to forecast accurate targets in any time frame in both directions. So if you're looking at a bull play or a bear play, or maybe you're just waiting to see which direction things play out, you have accurate targets that are forecasted above and below price so that you always know the odds of reaching those targets as we move forward toward those ends. So this is going to be a fantastic presentation here that really simplifies the ADR method approach, how I use it, and how I identify targets on my screen. Let's go ahead and get started with part 8, ADR method targets. The ADR method offers a complete approach to forecasting accurate multiple time frame targets for any instrument using average range. And so again, it kind of goes back to the principles that we've talked about before, where we've talked about price-based analysis and what's moving and influencing price, and why price is king at times, why volume is very important, those types of things. And this analysis flows very, very nicely with that. This is completely price-based analysis. So all we're doing here is looking at what the average range is for a given day, a given week, a given month. The whole point is you have to use just plain price range and then take an average of it. And then from there, you can forecast your targets. So real quickly, before we get into what the targets actually look like and how they're calculated, I wanted to talk a little bit about ADR. So right here, about ADR, basically this is just a quick snapshot of what ADR is and what's great about it, the advantages. So number one, you have it utilizes average price range. So that's very, very easy, very clear of what it's doing. So anyone, regardless of the platform you're using, can use this approach, even if you have something as simple as a calculator on your phone or a spreadsheet. When I first created the ADR method, I actually created it for RT trading, so real-time intraday targets. And this is the method I used for many, many years on identifying how far price could go in my favor. And so I would take the average range over a 10-session period, and then I would say, okay, the average range in the ES right now is 20 handles. So if this is the low of the day, if price comes down and boom, there's the low of the day and starts to move up, and I was pretty confident that was likely the low of the day, then I could then forecast from this low percentages of that average range. And then from there, I would know how likely it is to go in that favor. So if this low, say, was, 1900 right here, then on an average day, price should go about 20 points higher off that low, right? So 20 points up. And when I started to use this real time, I thought, wow, this is actually pretty brilliant. Price doesn't always go a full 100% in your favor, so I always traded to a 75% target. That's why I call it the primary. We'll talk more about that in a moment. But when I first created the approach, the method, I was just stunned at how this thing was working out in real time, day over day. And it made sense to me, obviously, but even though I teach some of this stuff and trade based off of it, it still never ceases to amaze me how well some of these things play out. And this was one of those things. So what I did was I took all of the data here that I had for the ES for a given period of time, and I started going back and just going back testing. How did it play out? What were the percentage accuracy of prices leading to the moves to these targets? And I was stunned. I was stunned by the accuracy that had played out in the back test, even though I had been trading it with good results. So I knew it would work. It was working. But I just didn't know how accurate it was. And it's all because it's based off average price range. I mean, it's just brilliant, it's simple, and it's easy. And it allows you to apply this stuff to any chart in any time frame, which is just brilliant. Again, what I really love about it is any tool we use, it needs to be self-adjusting to the current market's current volatility, and that's what this is. You know, if the market is currently trading, the ES is currently trading 20 points per day, then you want to trade to targets that correspond to this. If the ES is trading something like 45 points a day, then you want to trade targets that correspond to this bigger number. A 5-point swing on a 20-point day is much different than a 5-point swing in a 45-point range day. You know what I mean? This is a significant portion of that, whereas this is just a drop in a hat in this day. So you want to play the bigger targets when you have a 45-point range day or average day. So it just makes sense to adjust any approach that you're using to the market's current volatility so that you're playing within the rules of what price can do. Now, number 3 says it provides a consistent method for forecasting targets. That's extremely important. Again, consistency of execution in everything I do is very, very important to me. I have to be able to consistently apply a method, and you know, if you're identifying targets in a market, then you want to be able to consistently identify those targets across all markets and time frames. You know, what's your method for forecasting a target? Well, this is my method right here, just using average price. Obviously, we also use other targets as well, like value-based targets like VPOC, for example, or VWAP. But this is a way to just forecast targets based just simply off of price. And again, that gives you a different calculation to base your targets off of, which actually works really, really well. So number 4 provides bull and bear targets. So again, I'm very fond of analyzing the market above and below current price, even if I'm bullish. If I'm super bullish and I know price is going up, I'm still going to analyze prices below current price, because if price breaks down below those levels, I need to know what's happening already. And having bull and bear targets already mapped out for you is very important, because no matter which way price goes, you have reliable targets to play to. Now, number 5 is provides targets for multiple time frames. We'll be talking about daily, weekly, monthly targets. Those are the basic ones, and your daily and weekly will provide most of the bulk of what you're trading to. Oftentimes, I don't even have monthly on as much, but if I'm playing to a longer term move, then monthly is the way to go. But it's important to be able to create targets for all time frames, because there's all time frames of trades. You know, some trades are meant to go for just a few minutes, some are meant to go for a few hours, some are meant to go for a few days or weeks. So you have targets that you can play to accordingly. Now, number 6 is can be applied to any trading instrument. That's extremely important. So if you have a market is going to have price and it's going to have volume. That's what a market has, right? So if you have valid price and volume information, you're going to be able to use this method on that instrument and in that market. So if you trade ETFs, you'll be able to use this method. If you trade stocks, you'll be able to use this method. If you trade futures, you'll be able to use this method. And that's very important to me, again, because you can use one method for all the various instruments that you trade. This thing right here is very important. Number 7, helps anticipate price behavior via expansion and compression. Expansion and compression are some of our foundational price concepts, price-based concepts, where if price is currently in a compression phase, then ADR can tell us, it can qualify that compression. And if range is less than 65% of average range, like current range is less than 65% of average range, that is qualifying how coiled up that market is. And that tells you right away that you should be looking for expansion opportunities. Regardless of direction, it doesn't matter. A breakout can be significant. And the same thing with expansion. It can tell you how much and qualify that expansion. So it's very important. And then lastly, this provides a versatile built-in trade management approach. So the way I initially taught this is the way I initially traded it was, if I got into a trade, say price is here and hits my level right here and I get in somewhere, the first target to scale at would be the 50% target. and that one's going to be hit 90+% of the time. So that's a good high accuracy target to reach to, and then you scale there. So I would scale half my trade there, and then if price goes higher, you're looking to price to reach the 75% target, and this one has 80+% odds percent accuracy of being reached, right? And then you have the 100% right up here. I call that a secondary target. So this is the primary, this is the scaling, and this is the secondary. So if you enter a trade here, ideally you're taking off a portion at your scaling target. That's why it's called a scaling target. Then you're taking the bulk off or taking the remainder off at the primary target. And if you have any runners, that would go to your secondary 100. So we'll talk more about that as we jump into the charts. First, I want to just show here your daily calculations here. This is basically using average daily range. The way I do it is I average the sessions ranges from high to low over the last 10 periods. So this is a 10-period average. I also teach that you can use a 5-period average, and from there you can switch between 5 and 10-period averages to give you the current volatility and any change in volatility. So and we can talk about that a little more later. Weekly targets uses the average weekly range. Again, this is a 10-week average. So the average weekly range, what's the highest high and the lowest low of the previous week's range? And then the previous week's range over the last 10 weeks, what's the average range? And then from there, calculate the targets based off that range. The monthly uses average monthly range, AMR, average monthly range over the last 10 months. So what's the average size of the range, over the last 10 months? And from there, you're able to calculate your targets. Compression of a price range with regards to ADR is less than 65% of average. And that's why you see in my quote board in MarketDelta, you'll see whenever price is below 65% of average, that cell turns blue. So it tells me that things are in a compression state. Expansion is when things get above 125% of average range. So now you've seen expansion of 25% of average, and that can increase even farther. So again, we're able to qualify what's up. Now number 6 is impending volatility. That tells you anytime ADR for a current day gets above 200%, really over 150 or 175, but especially 200 is kind of like the big deal. If the current sessions range or the current range is over 200% of average range, that tells you that there's volatility entering the market, and volatility will likely increase as you go forward. So if you're seeing the Dow, or rather the ES trading 20 handles on an average day, and it's trading that 20, and then it's 22, and then it's 20, 1, and then over here, one day it's 19. So it's about trading that, and then all of a sudden you see a day where it's a 45-point day. Now it's traded, 200+% of average. That tells you, uh-oh, that's a big market event, and now you're likely going to see the market continue to trade in those ranges. So you'll get a day where it's 40, then a day that's 50, and a day that's, and then you see that volatility increase. So anytime you see a current session or a current range get over 200% of ADR or of average range, it suggests upcoming volatility that's going to likely enter the market. ADR targets here, they're layered in a way that allows you to focus on certain price levels with confidence, because we understand the likelihood of price reaching that target. And that's why I mentioned that I use these almost as a litmus test sometimes. If price is trading, here, back and forth, or down, and is mostly going down, I look to see how far down is the 100% target, because I know that there's going to be about 50% odds we reach there. How far down is the 75% target? Because I know there's going to be high odds to reach that one. Where's the 50% target? Have we already reached it? So then I know, okay, we have a very good chance of reaching this one. We have an outside shot of reaching that one. And then if you look for a 125 over here, that might be too far out. So these price levels might be too far away. So I shouldn't be looking to play to this unless price has just broken out of a compression phase and then you're likely targeting the 125% extended target. So each of these has a certain percentage of accuracy. So in the back test that I tested on, 50% had an average range of over 90% accuracy of being reached. One of the targets, either the bull or bear, in a given day. One of the targets, bull or bear, 75%, is usually reached over 80% on a given day. The 100% range was 50% accuracy, more about 55 or so, and then the extended target was less than 50% of being reached on any given day. Now keep in mind, this target right here, the extended target, has a 90% chance of being reached after compression. So if you had a compression day, so if the previous session was a compression day of less than 65% of average, the next session, or whenever you get that breakout, there's a 90% odds that you're going to reach the 125% target. So those are some of the nuances that help you, give you confidence that price could be headed to certain levels. So let's take a look at market delta and jump into the charts now. Okay, so here's market delta. I wanted to bring up a clean chart really quickly here. Let's go with this chart. All right. So this is just a clean chart of the ES. I can take off the previous high-low close. I can take off the open. And now you see that there's really nothing on this chart. Okay. So what we can do now is we can say, okay, here's the high of the day. Here's the low of the day. And that's the overnight high and the overnight low. What's the highest high of the day? What's the lowest low of the day? I think we got a little bit lower right here, but that was early in the day. So what average daily range, the ADR method, does is it says, what's the average range over the last 10 sessions for the ES? Well, according to our quote board here, the ES has been averaging 54.75 points per day. 54.75 points per day. It's currently trading just 36.75 points of range for the current session. So if this is 54, I'll call it just 55 points of range right now, what you would do is you would take this low and then you would forecast up 54.75 points. And in doing so, if you take that low and forecast it up, that gives you the 100% ADR target on the upside. And then you would take 75% of this figure, and that would give you your primary 75% target. You would take 50% of that figure, and you would get your 50% scaling target. You take 125% of this figure, and that puts you up here at a 125% scaling target. That's all we're doing. Whenever you see a new high or new low into the market, like this was a new low, it will then update those targets accordingly and move them down just a hair since there was a new low. So if I bring up the targets now, you'll see, at least the bull targets, right here on the toolbar is DADR, that's daily, average daily range targets. This is the weekly ADR and the monthly ADR. So this is the daily targets, and these are green, so it's the upside targets, a bull target. So if I click this target, you're going to see flags that pull up on the right. And this is in market delta. So these four flags are being calculated from this low right here. So this low plus 54.75 points gets you this level. So let's take a look at that low and just check our math real quick. So this low is 66. 1866 plus 54.75, that should give us 1920.75. So that's 1920 and a half. So it must be 65.75. 65.75 is the low. So you can see now that lines up nicely. There's the 100% target. That's why it's up here. Now, if you take half of that number, from here to here is half of 55. This right here would be 75% of 55, and that would be 100% of 55 from this low. And that's how those are forecasted, okay? So that's the upside targets. If you want to forecast the downside targets, then you would take the high of the day right there and forecast it down. 54.75 points. So this high, it appears this high is 1902.75. So again, bringing up the calculator and saying 1902.75 minus 54.75 gives us 1848. So if I bring up the bear targets, the 100% flag should be 1848. So let's bring it up, 1847.75. So right there, it's just there's a tick of math that's being off, but that's basically it. So if you take it from that high and forecast it downward, you're getting the 100% target. But see, this is a secondary target. One of the first studies I ever did as a I guess a pro trader, as you would call it, you know, going from amateur status in college and then going over to the pros. And one of the first studies I did, actually the first study I did, my first research that I did for Nirvana Systems was a consolidation study. And that was my first real assignment. And 6 weeks I worked on that assignment, and then I presented my findings to the Nirvana Club Bash. And really what I learned in that study, it was a consolidation study. It was looking at these, you know, consolidations. So typically speaking, if you get an impulse move up and then you consolidated highs, the expectation is you continue higher. But what you found also was that if you fail to hold and you break in the opposite direction, you actually see a move that's greater than what you would have saw if you would have just seen a continuation in the original direction. So that was very important to know those things, you know, to know how price reacts, failed range expansion concepts and topics. Average range is very, very important. By doing that study that I did originally, I knew that, okay, what you're looking for is, say, an impulse move from here to here. You take that range. What is that range? So then when we see expansion from the actual consolidation, you should see a move about the size of the range. And what I found was most times you would see a move, or a lot of times you would see a move that was completely equal to the distance of that range, but oftentimes you would fall just shy of it. You know, you'd fall about 90% of the way. So what I said was, you know what, I'll just play to a 75% target, because, you know, it didn't always get to 100%, but it got to 80 to 90% of the way most of the time, a high percentage of the time. So all I did was undercut that and say, I'm going to go 75% and make that my primary. And then when I started doing these approaches, that 75 was hit so much that I was just like, wow, I don't need the rest of this up here. If I can just get to that target, be happy, and move on with my trade. So that initial study helped me in terms of identifying average price range and how far price can go. And, you know, this is an average range, and this is where it should go based on the average 10-day range. But we know that markets don't move in perfect 100% averages. Otherwise, every day would be a 10-point day. The next day is 100% average would be another 10-point day. After that would be another 10-point day, or whatever the case is. Markets don't move that way. Sometimes it's a 10-point day. The other day it's an 8-day. Then you see a 14-point day. Then you see, you know, whatever the case is, right? And then that all averages out. So instead of playing to 100% as the primary, I did 75%. So you can see that study I did was back in 2001. And I've been using those concepts ever since. So this is based off of those concepts. So we play to 75, you scale at 50, and that's the way to go. Now, that's just the average range for a day. Now, if we take a look at the average range for a week, all we have to do is the same concepts, but let's take this off and let's put the weekly ones up. So here's a week and here's a week. So now if you scroll down, I don't do, if you notice, for the weeklies, I don't really have a scaling target for the weeklies. I mean, I could put it up, but I don't have a scaling target. I have a primary, you got the secondary, and then you got your extended target. Here's your primary, secondary, extended target. So I don't really use a 50%, but you can. I mean, I just don't plot it often. Not for the weeklies, not for the dailies. I usually plot 75, 100, 125, and that's what I do. So now what this is going to use is what's the highest high of the current week. And what's the lowest low of the current week? So right here, this is the lowest low of the current week. And then it would project 75% of the average weekly range over the last 10 weeks. Say the average weekly range is, I'll tell you exactly what it is. Let's bring up another quote board here. Let's bring up this one. So right now, the average weekly range, what are we looking at, the ES here? It's 81.75. 81.75 is the current average weekly range. So this is my ADR methods, ADR method swing or EOD target quote board. So these are the average monthly range, the current monthly range, the average weekly range, the current weekly range, and then these are the targets above and below, primary and secondary only. So over here, if we're trading 81.75, you would take this low and you project it up 81.75, and that would get you your primary, the 100% target. And in this case, that would be 1933. So 1933 is your primary target based on the low of the week. Based on this high of the week, you then project downward 100%, which is 81.75 or whatever we said. That would be that target. So this one would be the primary and this one would be the primary in that case. But you can see a lot of this is just back and forth here, just kind of rangy, which tells you that if this week right here gets too coiled up, and we don't see expansion heading to Friday, and we persist this way, the upcoming week could be seeing movement as far out as the 125% in one direction or the other, because this compression could lead us there. All right, so if we look at the higher time frame chart now, let's go back up to kind of a clean chart here. I'll get rid of some of these profiles, this one, and this one. And so here is the NQ in a daily time frame, and what we're looking at here is going to be the monthly ranges now. So here's the average monthly range above and below. Now you can see how they're kind of jumbled up a little bit right now, and that happens because our monthly range has been aggressively to the downside. So here you are, where you have the high of the month is actually the high of the first trading day of the year, and since then price is auctioned downward. This has been such a big push that, let me take off the bull targets so I don't confuse you. This has been such a big push that price went to the 75%, then to the 100%, and to the 125%. And we know that the 125% extended target doesn't get hit often unless it follows compression. This is compression. So when we saw expansion, we know that there's high odds that we're likely going to see a move to the expansion or extended target, right? So that gives you a great idea right there that most of the time when you're playing on those monthly targets, you should be playing to a primary and a secondary. But if you come out of a compression state and we see expansion out of a compression state, you should put that 125 target on the docket as well, because we're likely going to hit it, and we did. So very, very solid movement there. Now, because of this compression over here, the price range on a monthly basis probably shrunk a little bit. So you take this significant low and you project upward the average monthly range, and you're going to get the 100% target. So now if I take off these dailies, take off the monthlies here and bring up the monthly bull target, now it's saying, okay, here's the low. If this is the low, and we knew that was the low, right? At least short term. On that day, we said that's a significant tail event. This thing should go higher. Well, whenever it creates that new low, this is when you project your primary upside target for the week or for the month, whatever you want. In this case, this is for the month, and you can see it went right to it and then died. So if you would have played it from this low and say, okay, that's the low, and then you enter wherever you enter, you have high odds target at 42.46, and we got it. Obviously, I was playing to something a little higher, 43.40. We haven't quite gotten there. But getting on the right side of ADR here was the right call. But because we've seen so much expansion to the downside, you have, bear targets being forecasted here, they go down, and then you have this being forecasted for these bull targets going up. So now you get an overlapping field. So if I bring over the bear targets now, you see the overlapping field now, right? That's why you see them kind of all over each other, is because we had such a range. We have the high up here and it forecasts these downside targets here, here, and here. But then once we reach that low, it bounces back, and now we have the upside targets here, here, and here. Usually it's not that off, but once you get the month underway, it can happen that way. So those are the average daily range method targets for daily, weekly, and monthly. And I've shown you the quote pages here, along with this quote page, ADR target, ADR here in the range. You can see right here we're over 125% in crude oil for the day. So this is the average daily range on a 10-day basis is 235. 235, right? And then right here, that's 308, and that is the current day's range. So the current day's range is 131% greater, or 131% of average daily range. And that, anytime you get over 125, this cell turns red and tells you that that is an expansion market. It's overextended, or whatever the case may be. Watch it. If it's less than 65%, turns blue, and that's a compression state. That tells you right now the NQ is only trading, is trading 92 points of its 142 average range. That's huge. That's a compression state. And then down here, when it's just yellow, that tells you it's in the norm. It's in the norm somewhere between 65 and 125%, somewhere in there. That's the norm, so it's yellow. So that's kind of those targets there. And then you can bring these quote pages up, which are available on demand at the premium dashboard. You can get these downloads as well. All right, that pretty much sums up part 8 of our 10-part executive training series, which is ADR Method Targets. Again, this is a fantastic approach to seeing price movement in the market. I mean, using average range to forecast where price is heading on a daily basis, a weekly basis, a monthly basis, or even any user-defined custom, number of days. You can get the right values that you need out of the market. If you know that a product is trading 2 points per day, then you have a great idea on average where price could head in any given direction. And that gives you an incredible amount of empowerment, because now you really know, that price has high odds to reach certain targets. If they don't get reached, that's fine. Sometimes that happens. But having that knowledge, feeling that confidence, knowing that price has a great shot at reaching that target, only empowers your trade to reach that target even better. I mean, when you have a great full faith approach to trading there, that you really do believe that it's going to head to that target because, that target has a lot of basis, you're more likely to trade in a way that basically manifests that result. So that's fantastic a way to trade is knowing your tools, knowing the odds for how often they're going to be tested, what the tendencies and intricacies of that approach are. For example, getting over 200% of ADR, you're going to get increased volatility. Knowing those intricacies of the methods you use are very, very important. With ADR, there's so many different ways to use it. We're only scratching the surface, but using these ADR targets on your chart right now can make a world of difference. So that's all for part 8, ADR Method Targets of the 10-part executive training series. Thank you for joining me, and I'll see you soon.